Hey guys, this is Vyom Joshi with Superior North. Welcome back to my channel. This week we will be talking about a stock that I came across while going through the Japan Company Handbook, and that stock is called Panasonic. Panasonic is a leading consumer electronics manufacturer in Japan. In this video, we'll go over the company's business, then review the company's fundamentals by focusing on its key ratios, and finally perform a discounted free cash flow DCF analysis to find the intrinsic value of the company. So let's dive in and review Panasonic. Hey guys, let's briefly go over Panasonic's business description. Panasonic is a conglomerate that has diversified from its consumer electronics roots. The company has 5 main business units. The first is its appliances unit, which includes air conditioners, refrigerators, laundry machines, and TVs. The Life Solutions segment includes LED lighting, housing systems, and solar panels. The third is the Connected Solutions segment, which includes PCs, factory automation, and in-flight entertainment systems. The fourth is its Automotive segment, which includes infotainment systems and rechargeable batteries. And the last segment is its Industrial Solutions, which includes electronic devices. After the crisis in 2012, the management shifted its focus on growing its B2B segment portfolio in order to mitigate the tough competition in consumer electronics products. Now let's look at the revenue breakdown across these 5 operating segments. The first, the appliances segment, brought in about 2.5 trillion yen. The Life Solutions segment brought in about 1.5 trillion yen. The Connected Solutions brought in about 818 billion yen. The Automotive segment brought in about 1.4 trillion yen. And finally, the Industrial Solutions segment brought in about 1.25 trillion yen. So we can see that the appliances segment brings in majority of the company's sales. On page 23 of this report, the company provides us the revenue breakdown by region. For the year 2021, Japan brought in about 3.1 trillion yen. Americas brought in about 1.1 trillion yen, followed by other regions such as Europe, Asia, and China. Overall, we can see that about 50% of the company's total sales came from Japan. As far as the current events goes, Panasonic is transitioning to an operating company system. And what that means is each business segment that we just talked about is now going to be an operating business all by itself. And it's going to be all reporting to a holding company, which is going to be called Panasonic Holding Corporation. Panasonic further talks about this structure in its press release, where it provides us information about why they're planning on making this structural change in the organization. Panasonic says that the business environment surrounding the Panasonic Group is undergoing increasingly severe changes year by year, including politics and financial circumstances in each country, the widespread of protectionism, and the downturn of the market conditions due to the impact of COVID-19. Under such ongoing uncertainties, the company today resolved to transition to a holding company system in order to further enhance group management from a medium to long-term perspective. Panasonic then says that with the transition to a holding company system, the Panasonic Group will be divided into operating companies. Each operating company will thoroughly implement autonomous management based on clearly defined responsibilities and authority. As a result, each operating company will work to significantly enhance its business competitiveness through swift decision-making in response to changes in the external environment and flexibly develop systems in accordance with business characteristics. This structural change is likely to take place in April of 2022. So when we do buy a share of Panasonic right now, eventually that share is going to be renamed to Panasonic Holding Company, and that holding company is going to be in charge of all these operating companies and businesses that eventually report to this holding company. Now that we have a brief understanding of Panasonic's business, its operating segments, and the changes that are likely to take place in the next 12 months, let's review the company's fundamentals by focusing on its key ratios. Hey guys, I'm on Morningstar looking at Panasonic Corporation. Under key ratios, we have the financials. The first item on the list is the revenue. The revenue is the top line of the income statement. This is the amount of money that the company brings in via sales. Back in 2012, the company's revenue was about 7.8 trillion yen, and for the trailing 12 months, that number was about 7.1 trillion yen. Over the past 10 years, Panasonic's revenue has stayed fairly consistent, hovering between 7.5 to about 8 trillion yen. We did see a drop off in the year 2021, which was a unique year due to the pandemic. Next, looking at the operating income. The operating income is the amount of money that's left with the company once we subtract the cost of goods and operating expenses from the company's revenue. Back in 2012, the company's operating income was about 44 billion yen, and for the trailing 12 months, that number was about 373 billion yen. 2012 was a unique year for Panasonic. However, after 2013, the company's operating income hovered between 250 to about 500 billion yen. Next, looking at the net income. The net income is the bottom line of the income statement. This is the amount of money that's left with the company once it pays for the cost of goods, operating expenses, non-operating expenses, interest on its debt obligations, and taxes. Panasonic reported a loss in 2012 and 2013, which is why we see negative net income numbers for those 2 calendar years. Panasonic's net income in the year 2014 was about 120 billion yen. And for the trailing 12 months, that number was about 251 billion yen. Panasonic has been profitable ever since 2014, and its net income has hovered between 120 to about 285 billion yen. Ideally, we want to invest in companies whose revenue, operating income, as well as net income are either staying steady or increasing. Next, looking at the dividends per share. Back in 2012, the company paid out about 10 yen per share as dividend, and for the trailing 12 months, that number was about 20 yen per share as dividend. Over the past 10 years, there were only 2 years back in 2013 and 2019 when the company did not pay out any dividends. Other than that, the company has been paying out dividends. Dividends are important because that's a way for our shareholders to get our money back that we have invested in the company. Next, looking at the shares outstanding. Back in 2012, the company had 2,312 million shares outstanding, and for the trailing 12 months, that number had grown to about 2,335 million shares outstanding. Over the past 10 years, the company's shares outstanding number has grown a little bit, which tells us that the company has been doing some equity financing, and this process of actually issuing more shares dilutes the existing shareholders' ownership within the company. Next is the book value per share. The book value is what we get when we subtract the total liabilities from the company's total assets. Back in 2013, the company's book value was about 580 yen per share, and for the trailing 12 months, that number had grown to about 1,141 yen per share. Ever since 2013, the company's book value per share has been positive and trending upwards. That tells us that the company always had more assets than liabilities on its balance sheet, and the proportion of the company's assets to its liabilities is growing. Finally, looking at the free cash flow. The free cash flow is what we get when we subtract capital spending from the company's operating cash flow. Back in 2012, the company's free cash flow was negative. As we know, that was a unique year for Panasonic as the company's operating cash flow was a negative number. Back in 2013, the company's free cash flow was about 18.6 billion yen. And for the trailing 12 months, that number was about 424 billion yen. Ever since 2013, there were only 2 years when the company's free cash flow was negative, which was back in 2018 and 2019, primarily because the company's capital spending exceeded its operating cash flow. Ideally, we want the company's free cash flow to be positive, staying steady or increasing. I will be using the 2021 free cash flow of 207,611 million yen for my discounted free cash flow DCF analysis. Now let's look at the profitability of the company, focusing on the net margin. The net margin is the ratio of the company's bottom line to its top line, so it compares the company's net income to its revenue. Back in 2012 and 2013, the company's net margin was negative because the company reported a loss. For the year 2014, the company's net margin was about 1.56%, and for the trailing 12 months, that number is about 3.54%. What this means is every $100 that the company made over the past 12 months, by the time it paid for its cost of goods, operating expenses, non-operating expenses, interest on its debt obligations, and taxes, it had $3.54 left as pure profit. Next, looking at the return on equity. The return on equity is the ratio of the company's income to its shareholders' equity. Warren Buffett prefers to only invest in securities that have a return on equity of 8% or greater every year for the past 10 years. As we know, back in 2012 and 2013, the company's income was negative, which is why we're seeing negative return on equity numbers. Back in 2014, the company's return on equity was about 8.57%, and for the trailing 12 months, that number was about 10.74%. Panasonic's return on equity has been greater than 7% every year since 2014. Next, looking at the return on invested capital. This number gives an idea of how good the management is at allocating the company's capital and getting a return on that investment. Back in 2014, the company's return on invested capital was about 5.72%, and for the trailing 12 months, that number was about 6.32%. Panasonic's weighted average cost of capital, also known as the company's hurdle rate, is about 4.34%, and since the company's return on invested capital is greater than its weighted average cost of capital, we can safely say that the management is creating value for its shareholders. Finally, looking at the interest coverage. The interest coverage is the ratio of the company's income to its interest obligations. So it gives us an idea of how many times can the company pay off its interest using its income in that calendar year. Back in 2014, the company's interest coverage was about 10.41 times, and for the trailing 12 months, that number was about 21.96 times. Benjamin Graham, the father of value investing, preferred to only invest in securities that had an interest coverage of 5 times or higher. Now let's look at the financial health and liquidity ratios. The first item on the list is the current ratio. The current ratio compares the company's current assets to its current liabilities. Ideally, we want the company's current ratio to be greater than 1.0. Back in 2012, the company's current ratio was at 1.01, and for the latest quarter, that number was about 1.42. For majority of the past 10 years, Panasonic's current ratio was greater than 1.0. That tells us that Panasonic was never really in a liquidity bind. Next, looking at the quick ratio. The quick ratio is similar to the current ratio except we disregard the inventory component. In other words, quick ratio is equal to current assets minus inventory divided by current liabilities. A quick ratio greater than 1.0 tells us that the company does not have to rely on selling its inventory in order to fulfill its current liabilities. Back in 2012, the company's quick ratio was at 0.56, and for the latest quarter, it's at 1.04. Panasonic's quick and current ratios are much better now than they were 10 years ago. Next is the financial leverage. The financial leverage is the ratio of the company's total assets to its shareholders' equity. So financial leverage of 1.0 tells us that all of the company's assets are financed via its shareholders' equity. A high financial leverage tells us that more of the company's assets are financed via liabilities. Back in 2012, the company's financial leverage was at 3.42, and for the latest quarter, it's at 2.61. Ideally, we want the company's financial leverage to be staying steady or decreasing, and we can see that Panasonic's financial leverage has slowly been trending downwards. Finally, looking at the debt to equity ratio, this ratio compares the company's total debt to its shareholders' equity. Ideally, we want the company's debt to equity ratio to be less than 1.0. It's even better if it's less than 0.5. Back in 2012, the company's debt to equity ratio was at 0.48, and for the latest quarter, it's at 0.41. Panasonic's financial leverage and debt to equity ratios are a lot better now than they were 10 years ago. Now let's look at the efficiency ratios. The first item on the list is the day sales outstanding. This number gives us an idea of how many days go by from the day the company recognizes its sale to the date it actually receives cash for that service rendered. Back in 2012, the company's day sales outstanding was about 45 days, and for the trailing 12 months, that number is about 56 days. Ideally, we want the company's day sales outstanding number to be staying steady or decreasing, and we can see that Panasonic's day sales outstanding number has been trending upwards, but it's not growing at a rapid pace where we would be concerned that the company is being aggressive with its accounting to the point where it's aggressively recognizing its sales so that it can inflate its income numbers on its income statement. Next is the days inventory. This number gives an idea of how many days does the company's products sit in its inventory. Back in 2012, Panasonic's days inventory was about 54 days, and for the trailing 12 months, that number is about 65 days. Ideally, we want the company's days inventory number to be staying steady or decreasing. In the case of Panasonic, the company's days inventory is growing, which tells us that the company is not as efficient with its inventory now than it was 10 years ago. Finally, looking at the payables period, this number gives an idea of how many days does the company take to pay its suppliers. Back in 2012, the company took about 51 days to pay its suppliers, and for the trailing 12 months, that number was about 70 days. Ideally, we want the company's payables period to be staying steady or decreasing. A rapidly growing payables period tells us that the company may be trying to hold on to its cash in order to artificially inflate its cash flow numbers. In the case of Panasonic, the company's payables period has been growing. However, it's not growing at a rapid pace where it's a cause of concern, but definitely something to keep an eye on. Now let's compare Panasonic's current valuation to that of the S&P 500. The S&P 500 is the aggregate of the top 500 companies in the United States. The first item on the list is the price to earnings ratio. Panasonic's PE is at 12.3, whereas S&P 500 is at 24.1. Panasonic's price to book is at 1.2, whereas S&P 500 is at 4.3. Panasonic's price to sales is at 0.4, whereas S&P 500 is at 3.0. Panasonic's price to cash flow is at 4.2, whereas S&P 500 is at 17.2. And finally, the dividend yield. Panasonic has a dividend yield of 1.9%, whereas S&P 500 is at 1.5%. So on all these valuation metrics, we can see that Panasonic is undervalued when compared to the S&P 500. Now let's look at Panasonic's discounted free cash flow DCF analysis. Over here, I pasted the company's 2021 free cash flow number that I got from Morningstar, which was 207,611 million yen. I'm assuming the annual growth rate of free cash flow to be 6%. What this means is I expect the company's free cash flow to grow at 6% every year for the next 10 years. I'm using a discount rate of 10%. What this means is I want this investment to give me a 10% return. I'm using a long-term growth rate of 4%. What this means is after the 10-year mark into perpetuity, I expect the company's free cash flow to grow at 4%. The company has 2,335 million shares outstanding and has a long-term debt of 879,728 million yen. I got this number from the company's balance sheet. After taking all of these inputs into account, we get the company's intrinsic value to be about 1,378 yen per share. When we compare this intrinsic value to the company's current stock price, which is at 1,378.5 yen per share, we can see that the current stock price is neither under nor overvalued. The way we calculate this intrinsic value is we look at what the free cash flows would be every year for the next 10 years. We sum up all those free cash flows, which come out to about 1.7 trillion yen. Then we look at what the free cash flows would be after the 10-year mark into perpetuity. We sum all these up to get the intrinsic value to be about 4 trillion yen. From this number, we subtract the long-term debt and divide by the shares outstanding to get the intrinsic value to be about 1,378 yen per share. Now, if we disregard the perpetuity component, in other words, if you think that Panasonic is only going to grow for the next 10 years and then it'll cease to exist, then we get the intrinsic value without the perpetuity to be about 353 yen per share. And if we disregard the debt, In other words, if you think that Panasonic is going to grow into perpetuity, so there's no point for the company to worry about its debt, then we get the intrinsic value without the debt to be about 1,755 yen per share. So overall, Panasonic has good fundamentals. The company is going through a structural change in April of 2022, which should unlock a lot of value for existing shareholders. The company is neither under nor overvalued at the current stock price using a DCF analysis. However, when we compared the company's current valuations to those of the S&P 500, we saw that the company is undervalued when compared to the S&P 500. Hey guys, that is all I had for you this week. Hopefully you found this video on Panasonic interesting. If you like this content, please do like, share, comment, and subscribe. And if you have any suggestions on which stock I should review next, please leave it in the comment section below. I'll greatly appreciate it. Thank you.